Disney announced yesterday that James Gorman will replace Mark Parker as chairman of the board effective in January. Parker, who is leaving that role, also serves as the executive chairman of Nike. So could the shakeup be a win-win for the two struggling companies? Our next guest published bullish notes on each one of them this morning. Ben Swinburne sees an investment year, then an inflection year ahead for Disney with 15% upside. And Simeon Siegel is bullish on Nike, saying the Parker news is a positive for the stock. Welcome to both of you. Ben, let's start this conversation asking why you think this will pay off for Disney from here instead of just being another period of turmoil.
Well, I think the important thing, Kelly, and thank you for having me on, is that the process is robust and also that there's a clear timeline. This certainly has been a big focus, particularly in Hollywood. You can imagine that town is very focused on management changes at the Walt Disney Company. And so putting a timeline of early 26 out there, I think, gives investors, the press, and employees some clarity and hopefully some comfort around a robust process and a timeline to make the next appointment.
I also thought it was interesting to learn, Ben, I hadn't realized that James Gorman sees himself as something of a CEO whisperer. Does his elevation to chairman give you some confidence about the transition plan? And it's also a little bit strange to be having this discussion because the first time around when Iger was so vaunted and the stock was doing so well, transition seemed like a big deal. This time around, I'm a little less clear what they're searching for because the company itself is trying to right the ship.
Well, look, I think the Walt Disney Company has a lot of different businesses, and media is an area of tremendous disruption, innovation, and change. I mean, you and I have talked about that on your shows many times over the years. And so this is a very important role, the CEO of the Walt Disney Company, not just in shaping the future of Disney, but the future of the entire entertainment industry. And so there's a lot, that they're looking for, I'm sure, in terms of skill set and experience. And we certainly feel confident they'll get there, make the right choice.
So what would you say the most important thing to look for in the next CEO would be?
Look, I think there's multiple things that are important, but the two things I would mainly highlight is number one, creativity, understanding the creative elements that go into creating great content and really monetizing and building brands and franchises around the world. And then secondly, the biggest business at Disney, which is really the focus of our report today in many ways, is the experiential side. It's 60% of earnings comes from their parks and experiences businesses. If you think about it, that is the primary way in which the Walt Disney Company monetizes their great brands and content. That is a massive business. I mean, it's 30 billion plus in revenue a year globally, cruise ships, hotels, parks. So understanding how that business works operationally and where the investments need to be over the long term is equally as important as the creative side. And so that's a rare, combination, but it's a rare role, obviously.
It also makes it an interesting stock multiple to contemplate because it was one thing when ESPN was the juggernaut, was 40% of EPS or whatever, and you could assign the multiple that maybe now wasn't deserved to that, but it was such a unique opportunity at the time. Now we're talking about a parks business, an experiences business. I mean, there's other publicly traded stocks in that realm, but is that a thrilling way to kind of have a high multiple and make money over a long period of time?
Look, there's not a lot of businesses that I've looked at that are doing over 30 billion in revenue and have a 20-year history of CAGRing earnings in the high single digits. Think about the barriers to entry in the Walt Disney Parks business. They're enormous. Obviously, you have to have the brands, the content, the princesses, the superheroes to make it all work. Absolutely, in our view, that is a high multiple business. And it's not just parks. If our forecasts are roughly right, the contribution from parks, streaming, we know about Netflix's 30 PE multiple, and their studio will go from 60% to 80% over the next several years as the sort of traditional linear television business shrinks and these other businesses grow. And then, of course, we'll have to see where they go with ESPN over the next couple of years. But yeah. I think actually the multiple you would assign to Disney's earnings is going to expand over time as we see these higher return, better positioned businesses grow in earnings contribution.
It's a really interesting. I think they literally have a moat. Do they around the cap? I don't know if I've been, but
literally and figuratively.
Indeed.
Yeah.
Ben